Joining us now is Stephanie Link, Hightower Chief Investment Strategist and a CNBC contributor. Steph, good morning. Good morning. It seems like, as we all know, the market kind of entered August kind of hot. We were maybe a little bit stretched technically. And I think that, interestingly, too, the response to earnings reports, even though earnings have been, on balance, quite good relative to expectations, it's been a little bit of a ungenerous response by the market. So what does that tell you in terms of what the market's already essentially priced in here?
And good morning. Seriously, we've had like a really great run year to date, up about 17% in the S&P 500. And you know, Mike, the long-term total return average for the S&P 500 is about 7%. So we are definitely having a good year. Definitely makes up for last year for sure. But I think we're probably going to see a kind of a choppiness, if you will, in August and maybe even into September. But I'm encouraged that earnings are hanging in and that we are seeing a broadening out in the market. And I think there's opportunities to be had as a result.
And in terms of the yield move that has obviously gotten the market's attention, gotten investors' attention above 4%, you know, there's no magic level that means one thing or another for where the stock market can trade. But above 4% has tended to be a stop and wait and back off level for the market. So can this be absorbed?
Well, yes, certainly. And again, that's going to be part of the chop that we see this month, maybe next month, maybe until the end of the year, Mike, right? So because we've had a really nice results so far this year. I think overall, I just continue to watch the macroeconomic data, and that continues to be better than expected. The job market continues to be very healthy, whether you look at ADP, initial claims, JOLTS, even the non-farm payroll number on Friday was perfectly fine. It's very healthy. Wages are actually on the rise at 4.4%. Consumer continues to hang in there. It's not all perfect, of course, but I do think that there are opportunities, as I mentioned. I think the most important, by the way, the most important data point from last week was the productivity number coming in way better than expected, as well as the unit labor cost number coming in lower than expected. That directly feeds into GDP. And, you know, we've seen an acceleration in GDP year to date. I think all that is really healthy. That's good. So if we do chop around, as I mentioned, there are opportunities out there when stocks pull back and you see the volatility increase. I think you have to look for bottoms-up fundamental stories that are on sale.
Yeah, I mean, certainly the productivity growth has been a missing piece of the story, and It would be great if it continues. Those numbers do bounce around, but absolutely it's been a help most recently. What types of stories make sense here? We did see, Apple, which had been just kind of going up in this very, very orderly upside angle. It seems to have broken a little bit. So I just wonder if that means there's a change of character in this market and where it looks like things might be able to firm up.
Yeah, no, and so to that point, yeah, I mean, Apple's had a nice run year to date. The FANG stocks, technology, growth, all have had really nice moves. I think you want to look elsewhere. I think you want to look at some of the other parts of the market that are starting to perk up, Mike, right? So we are seeing the broadening out energy, industrials, materials, some financials for sure. I think Apple takes a breather. I think that quarter was fine, right? I mean, we didn't like the iPhone numbers or iPad numbers, but services was quite good. And that's now 25% of total revenues. But trading at 33 times, it was priced for perfection, and you didn't get perfection. You had an inline quarter. So nothing wrong with it, but I think it might pause for a while. On the flip side, we saw something like Fortinet on Friday, cybersecurity, get crushed at down 25%. That's the kind of opportunity I'm looking for. I own it, so to be fair, it was a little bit of a bruising on Friday for me, but I do not think the long-term algo is changed of mid-teens growth, 100 to 200 basis points of margin expansion per year, 20% free cash flow growth. So again, like it's down 25%. What do you want to do? You want to take advantage of some of those kinds of names. That being said, if we do see a broadening in the market, technology may lag and these other sectors might do better and they're cheaper for sure.